Hi and happy US Jobs Friday, everyone. We are Friday, October 4th. Investors around the world are holding their breath before the US jobs data are due later today to reshape and maybe review their potentially too dovish expectations regarding the US Federal Reserve interest rate cuts as the rising oil prices and strike in US ports threaten to revive inflationary pressures. So welcome. You are watching Swissquote's Daily Market Talk. So we had a couple of big market movers this week besides the US and the Fed. And one of them is these escalating geopolitical tensions in the Middle East and the impact on global oil prices. And second is the surprise dovishness that we heard from the Bank of England governor, Mr. Bailey, yesterday. So we will discuss about all that in this episode and also the upcoming and all-important US jobs data. But first, let's start with Middle East. Because global headlines were shaken yesterday, literally shaken, by the news that Israel is considering striking Iran's oil facilities and that more importantly, US President Joe Biden may let Israel do it. So this comes after Iran's latest attack on Israel, which was in response to a Hezbollah strike on Israel, remember? And that, of course, followed Israel's ongoing conflict in Gaza. So it's a very, very complex chain of events in the Middle East. But the possibility of Israel targeting Iran's oil infrastructure is definitely raising eyebrows around the world and also giving a decent energy boost to oil prices. So the barrel of US crude closed nearly 4% higher yesterday's trading session and above a critical Fibonacci resistance, the $72.85 per barrel level, which is the major 38.2% Fibonacci retracement on July to September retreat. As such, US crude has now left its bearish trend that was building since summer and stepped into the medium-term bullish consolidation zone. And the next resistance stands at $75 per barrel level, which is a 50% retracement, then $77 and $80 per barrel levels. The upside potential is clearly there. The rising tensions in the Middle East, if coupled with the threat of lower Iranian supplies, should actually give a further reason to the oil bulls to extend their tactical long positions. But it's also very important to keep in mind that the gains that are made on the back of these rising geopolitical tensions of the Middle East will sooner rather than later be given back. I mean, look, even the war in Ukraine, which started now, 2.5 years ago, and which erased Russia from the list of oil providers to the Western economies and is still ongoing with the same intensity, mind you, didn't have a lasting impact on global oil prices. So this means that the tactical longs will obviously benefit from the rising tensions in the Middle East as long as they last, or until the focus will return to the market fundamentals of ample global supply from OPEC and non-OPEC countries and prospects of slowing global demand. Voila. Now, even though the rise in oil prices should not last very long, they may actually have an impact on the short and medium run inflation outlook and inflation expectations. Because we tend to forget, but the spike in oil prices following the Russian invasion of Ukraine was, remember, one of the major reasons that actually sent global inflation spiraling higher, and the rest was the supply chain disruptions. And today, the US is experiencing both in obviously a smaller proportion, but it's experiencing both. The war in the Middle East has started to show in energy prices, and the strikes that we see in its East and Gulf ports are disrupting the goods inflows into the country. And according to Sea Intelligence, should the strike in US ports last something like 4 weeks, for example, which is not impossible per se, it would cause 7% of the global fleet to be tied up along the US East Coast, and that the overall impact on the supply and the demand equation will be very significant, they say. And on the other hand, Bloomberg Economics estimates that the strike cost $3 billion a day in lost spending and lost production. And that's much wider, much bigger than Oxford Economics that were just estimating $4.5 to $7.5 billion per week. But anyway, the thing is, it will cost a lot of money to the US and a lot of money potentially to the world that will obviously be feeling the ripple effects on the global supply chains. Now, I still don't think that the latter will be comparable to what we saw during the pandemic times. Far from that, but it will, at least in my opinion, get the Federal Reserve members to question their overly optimistic view about their inflation fight, and maybe also their overly dovish stance regarding their rate policy. Now note that the expectation of another jumbo rate cut from the Fed is melting by the day. Activity on Fed funds futures now gives less than 1/3 chance of another 50 basis point cut from the Federal Reserve in its November monetary policy meeting, especially given that the recent economic data from the US hasn't been that bad, really. Because released earlier this week, remember, both the US JOLTS and the ADP reports have actually surprised to the upside. Then the ISM manufacturing index show further weakness in the US manufacturing activity and prices and employment, but yesterday's ISM services data revealed a stronger than expected expansion both in terms of activity and prices, because the prices component of the ISM index soared to nearly 60, mind you. And overall, Citi's US surprise index, which has hit a bottom back in summer, rebounded strongly since then, and that index stepped into the positive territory lately, meaning that there are more positive surprises to the economic data these days than negative surprises, and that, the market does, or the Federal Reserve does, have probably went a bit far ahead of themselves, and that these expectations should be reviewed. But anyway, this being said, today's US jobs data will be very, very important in providing a final conclusion to, this week's so far stronger than expected US jobs figures. Now in numbers, the US economy is expected to have added nearly 147,000 new non-farm jobs in September. The unemployment rate may have steadied near the 4.2% level, and wages in the US may have grown slightly slower than they did last month, but still by 3.8% on a yearly basis, which is still a bit high to me. Now, the rationale behind is always the same. A set of soft US jobs figures from the US has totally the potential to fuel the dovish Federal Reserve expectations, weigh on the US yields, weigh on the US dollar, and perhaps keep appetite in equities quite robust. A stronger than expected set of figures, on the other hand, should actually bring the Fed doves back on earth, lead to a further rebound in the US yields and the US dollar because of a retreat in Fed dovish expectations, and probably weigh on equity investors' appetite as well. So we will see what the figures sell, but the US dollar, on the other hand, will likely remain under the positive pressure of softening major currencies elsewhere, because after the Japanese yen sell-off that we saw earlier this week, the British pound took a severe hit at yesterday's trading session after the Bank of England governor, Mr. Bailey, said in an unusually dovish statement that the bank could become a bit more aggressive and a bit more activist in its approach to cutting the interest rates. So cable tumbled more than 1% at yesterday's trading session in just a single session, and remains under a decent selling pressure this morning. The Bank of England's hawkish monetary policy stance and its surprisingly strong economic performance in the first half of this year were the major drivers of the sterling bulls this year, and both look like they are in jeopardy at this point in time. So this is all for this week, guys. I'm İpek and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. And follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.